want to know about a lesser known mutual fund that will give you the highest return compared to all other mutual funds, these funds are at the highest level of the risk and return spectrum. And if you want to make a killing in the stock market, then these mutual funds should definitely be part of your portfolio. Introducing sectoral mutual funds. In this video, I will not only give you the names of top 3 sectoral mutual funds, but I will also tell you about the advantages of investing in these mutual funds, difference between sectoral mutual funds and thematic mutual funds, important points to consider before investing in these funds. Sectoral mutual funds is a category of equity mutual funds that concentrate their investment in a particular sector or industry of the economy, like pharma, real estate, FMCG, capital goods, etc. It allows us to have a concentrated exposure to a particular sector or industry rather than diversifying across multiple sectors. If you are currently doing a business or in a job in a particular sector of the economy, then analyzing that sector would be easy for us. For example, if you are a doctor, then analyzing medicine companies, medical device companies will be suitable for you as you already have expertise in that field. On the other hand, if you are an engineer, then analyzing capital good companies, civil engineering companies or mechanical engineering companies will be suitable for you. These funds are subject to market risks and require careful evaluation of sector performance, industry regulation, and macroeconomic trends before investing. For delving into sectoral mutual funds, a minute understanding of market trends is necessary for effective timing for entry and exit. Staying up to date with latest sector-related news and conducting thorough research on government regulations in that particular sector is crucial for making informed decisions in this domain. The first advantage is potential for higher returns. Since sectoral mutual funds are focused on a specific sector of the economy, so they have the potential to outperform other diversified funds during market upswings or when the sector goes into a boom cycle. Second point is easy entry and exit. Sectoral mutual funds offer easy liquidity, allowing investors the opportunity to entry and exit the fund at their own convenience without any lock-in period. Third point is diversification within the sector. Though those sectoral mutual funds are concentrated in one industry, they offer diversification within that sector. For example, a healthcare fund might include pharmaceutical companies, medical device companies, or biotechnological companies, spreading risk across different subsectors. Fourth point is hedging against economic cycles. Certain sectors perform well during economic downturn, making sectoral funds useful for hedging against broader market declines. Defensive sectors like consumer staples and healthcare offer stability during economic downturns. Sectoral mutual funds have some significant risk which every investor should be aware of before investing his money into these funds. The first major risk is lack of diversification. Sectoral mutual funds are heavily influenced by sector-specific events like policy changes, economic downturns, or technological disruptions. This makes them highly volatile. For example, pharma funds delivered a negative return of -10% during 2022 as demand for COVID-related healthcare products declined during this period. But in the same time period, diversified mutual funds delivered a return of 10%. Second point is market timing risk. Successful investment in sectoral mutual funds require accurate market timing just when the targeted sector is about to go on an upswing. Incorrectly timing the entry or exit from a sectoral fund can lead to substantial losses. Third point is economic and regulatory risk. Sectors can be heavily influenced by economic conditions and government policies. For instance, healthcare reforms by the government can drastically affect healthcare funds, while change of energy policies by the government can impact energy sector funds. Though sectoral mutual funds and thematic mutual funds are both equity mutual funds, where at least 80% of their assets are invested in the stock market, but still there are some minor differences between the two, which we will discuss now. A sectoral mutual funds gives exposure of buying companies in a single sector like IT, pharma, telecom, etc. Whereas a thematic mutual fund invests in several sectors that surround a certain theme like energy, rural India, infra, etc. For example, energy theme may include various companies which are part of different sectors, but still they are all part of the same theme, like Oil India Corporation, which is a oil exploration and refining company, Adani Energy Solutions, which is a renewable energy company, or Coal India, which is a coal mining company. All of these companies are in different sectors, but still they are part of the energy theme. Second point is sectoral mutual funds have more concentration risk as they invest in one sector only, whereas thematic mutual funds are broader in scope than sectoral mutual funds as they are in multiple sectors. This makes thematic funds more diversified with less concentration risk. The first sectoral mutual fund that I have selected for the year 2025 is DSP Natural Resources and New Energy Fund Direct Plan Growth. This mutual fund has renewable energy companies as well as steel sector companies. It also has some natural resources companies which are into the oil and gas and refining sector. India's installed renewable energy capacity reached 205 gigawatts, putting it on a smooth path to achieving the 500 gigawatt target by 2030. Investment in renewable energy sector is poised to double to over 32 billion in 2025. India is projected to lead major steel consumer economies with an 8 to 9% growth in steel demand in 2025. This surge is attributed to increased adoption of steel-intensive construction methods in housing, infrastructure, engineering, etc. The fund size of this mutual fund is 1,212 crore. Expense ratio is 1%, which is quite reasonable. The fund has nearly 84% investment in domestic equities with 42% in large cap, 22.7% in mid cap and 9.75% in small cap stocks. Portfolio turnover ratio is 29%. Number of stocks that the mutual fund is currently holding is 22. The 1-year return of this mutual fund is 7.34%. 2-year return is 18.66%. 3-year return is 16.64% and 5-year is 22.13%. The second sectoral mutual fund that I have selected for the year 2025 is ICICI Prudential Pharma Healthcare and Diagnostic Fund Direct Plan Growth. In the year 2024, pharma and healthcare mutual funds have offered the highest average annual return of around 38%. India's pharma industry has been on an upswing in recent times. The government wants to make India a reliable pharmacy of the world. The production-linked incentive scheme in pharma and medical tech sectors has been a roaring success, with government revving up support for drug development in India. As many as 16 blockbuster molecules targeted for a wide range of therapeutic areas like cancer, diabetes, HIV, tuberculosis are in the pipeline to be produced in India. A big boost for the Indian pharma industry could be a new American law in the making, the Biosecure Act, This proposed law aims to protect American intellectual property from foreign entities, especially from Chinese companies. This bill would restrict the ability of US companies to work with certain Chinese biotechnological companies, and this would in turn be an opportunity for Indian companies or Indian pharma companies to collaborate with the US counterparts for joint drug development. The fund size of this mutual fund is 5,320 crore and the expense ratio is a little over 1%. This mutual fund has 98% investment in stocks of domestic companies, of which 40% is in large cap stocks, nearly 17% is in mid caps, around 12% is in small cap stocks. Portfolio turnover ratio is 95%, which means that the fund manager sells 95% of the stocks in its portfolio before holding it for 1 year. The mutual fund is currently holding 41 stocks in its portfolio. This sectoral mutual fund has given very handsome returns of 29% in the past 1 year. In 2 years, it has given a return of 40.51%. In 3 years, it has given a return of little over 24%. In 5 years, it has given a return of 28.49%. The third sectoral mutual fund that I have selected for the year 2025 is Tata Digital India Fund Direct Plan Growth. India's digital economy is expected to grow almost twice as fast as the overall economy, contributing to 1/5 of national income by 2030. India is the third largest digitized country in the world in terms of economy-wide digitization and 12th among the G20 countries in the level of digitization of individual users. In less than 6 years, the share of digital economy will be more than agriculture or manufacturing in the country. Digital platforms are expected to grow rapidly with anticipated growth rate of 30% in coming years. The fund size of this mutual fund is 12,962 crore. Expense ratio is very low, around 0.4%. This mutual fund has 95% investment in domestic equities, of which 56.53% is in large cap, 7.73% is in mid cap stocks, and 15% is in small cap stocks. Portfolio turnover ratio of 20%, which means that the fund manager sells 20% of the stocks in its portfolio before holding it for 1 year. This mutual fund has 37 stocks in its portfolio, given very good returns of 22.52% in the past 1 year. In 2 years, it has given a return of a little over 28%. In 3 years, it has given a return of 14.11%. And in 5 years, it has given a return of 28.31%.